Welcome to the Deep Dive. We're here to cut through the noise and get straight to the insights that, well, really matter.
That's right.
Today we're digging into FedEx, their fiscal 2025 performance, how they're navigating, pretty tricky economic environment, how they're changing things internally, and also touching on the huge legacy of their founder, Fred Smith.
Yeah, we've gone through their latest financials, the earnings call transcripts, really sifted through the data.
So you get the full picture.
Exactly. We want to give you that multifaceted view, what's genuinely important here, and what it signals for global commerce and business strategy more broadly.
Okay, so our mission today, unpack FedEx's financial health. Look at these big strategic changes they're making. See how they're handling this dynamic global scene.
And I'm all while acknowledging a major figure.
A truly pivotal figure in their history. Right, let's dive in. And we really have to start with a moment of reflection, don't we?
We do. It's significant news.
The sources confirm the sad news, the recent passing of FedEx founder, Frederick W. Smith, at 80. He was the executive chairman, the longtime CEO, just an icon.
A giant in the industry, truly.
Raj Subramaniam, the current CEO, gave this really heartfelt tribute. He talked about Fred's pioneering spirit in express delivery, shaping global commerce.
His impact is just immense.
Absolutely. And not just innovation, but leadership, philanthropy, a legacy that's going to, inspire for a long time.
Definitely.
Subramaniam also added a personal note. He said he'd miss Fred's vision, yes, but also his friendship, his counsel.
That personal connection.
Yeah, and how Fred taught him that leadership. It's really about service, not just the title.
That's a powerful message. And, the company handled the transition smoothly. The board quickly elected Brad Martin as the new chairman.
Consistent with the plan. Right.
Completely consistent with their succession plan. And in a way, that smooth transition kind of mirrors how they navigated the whole fiscal year. They ended fiscal 2025 on a strong note.
Investors seem to like it.
Yeah, sentiment was positive. Stock ticked up about 1.16% after hours. And Investing Pro, they actually see the stock as slightly undervalued still.
Okay, so let's talk numbers. Q4. I looked at these, and honestly, they're pretty impressive.
They really are.
They didn't just meet expectations for earnings per share and revenue. They beat them pretty handily. Diluted EPS was $6.88, or $6.07 adjusted.
Which was well above the $5.96 forecast.
Exactly. And revenue hit $22.2 billion, also beating the $21.84 billion expected. And for the full year, $87.9 billion in revenue.
That full year number is substantial, but what really stands out, I think, is this is their second year in a row of earnings growth.
Despite everything going on globally.
Despite the global challenges, yeah. It shows real resilience, and it points directly to how effective their internal cost-cutting has been, especially that DRIVE program.
Creating a buffer, maybe.
Sort of a buffer, exactly. Against those external pressures, it kind of sets a new standard for agility in a tough industry. And Investing Pro gives them a good overall score. Their gross profit margin is healthy at 27.2%. It backs up the story.
Okay, let's unpack that agility. The DRIVE program that seems absolutely core to their recent success.
It really is.
The sources say they hit their target. That $2.2 billion for fiscal 2025.
They did. They achieved that $2.2 billion DRIVE structural cost reduction target for the year.
Which sounds like a lot.
It is. And if you look bigger picture, it means they've delivered a total of $4.0 billion in these DRIVE structural cost cuts compared to fiscal year 2023.
Wow, $4 billion.
Yeah. And those savings, they were the main reason operating income and margin improved in Q4, even with those ongoing headwinds they keep mentioning.
It's about efficiency creating breathing room.
Precisely. Aggressive focus on efficiency.
Okay, $4 billion from DRIVE is huge, but is that just the start? What's this Network 2.0 thing they're talking about as the next step? How big is this transformation?
That's a great question, because Network 2.0 is definitely the next leg, and it's a really big deal.
Okay.
It's all about integrating their different networks, express, ground, etc., and cutting the cost to serve even more.
How's it going so far?
Well, they finished the full optimization in Canada back in April. That was their biggest market yet.
Okay, a major test case then.
Exactly. And in Q4, they optimized 45 stations in the U.S. They're speeding up, too. Nearly 30 stations across 11 markets on June 1st, another 33 across 9 markets by the end of June.
So that's bringing more volume into the optimized system.
Right. By the end of June, roughly 2.5 million average daily packages will be flowing through these Network 2.0 optimized stations.
And the goal? the savings goal?
The target is another $2 billion in savings from this physical network integration, plus related One FedEx stuff by the end of fiscal year 2027.
That's ambitious.
It is. They call it a long game exercise, but they say they're on track. They're already seeing about a 10% improvement in pickup and delivery PU, they call it, at the locations they've transitioned.
How many locations are we talking about?
As of the end of FY25, they've closed 100 stations, integrated 290, and the long-term goal is to eventually remove about 30% of their surface facilities. It's a massive overhaul.
30%?
Yeah.
That's really substantial. But scaling something like this across a network as huge and complex as FedEx's, there must be risks, right? Potential hiccups.
Oh, absolutely. It's a valid concern. The sheer scale means execution risk is always there. Integrating operations across different segments, different geographies. It's complex.
Yeah, how are they managing that?
Well, their phased approach, like doing Canada first, suggests they're trying to learn and mitigate as they go, but yeah, it's a challenge. For fiscal 2026. They're targeting another $1 billion in savings from D-Drive and Network 2.0 combined,
$1 billion more next year.
with a moderate ramp up through the year. It ties into their whole capital management strategy, really.
How so?
Well, look at fiscal 2025. They returned about $4.3 billion to stockholders. That was actually more than the $3.8 billion they initially planned.
Mostly buybacks.
$3 billion in buybacks, yeah, and $1.3 billion in dividends.
And the capital spending itself, that number caught my eye. It was way down.
It really was. $4.1 billion in CapEx for fiscal 2025. That's down 22% from the year before.
Lowest in over a decade, this source has said.
Lowest in over 10 years, yeah. And CapEx as a percentage of revenue, 4.6%. That's the lowest it's been since 1998 for FedEx Corp. It's a historic low.
That's incredibly lean for a logistics giant. How much leaner can they get?
Well, it signals a potential shift, maybe industry-wide. Logistics used to be all about expansion, more hubs, more planes.
Build, build, build.
Right. Now FedEx is showing maybe the next step is intense capital efficiency, disciplined shareholder returns. 85% of that lower FY25 CapEx. It went to modernizing fleets, optimizing the network, automation.
Not just adding more capacity.
Exactly, not capacity expansion. It's like redefining success.
Yeah.
Focus on shareholder returns, ROIC. It's an inflection point, as they put it.
And for FY26, more of the same approach.
Seems like it. They're committed to returning capital. They already announced a 5% dividend increase to $5.80 a share, and they plan more share buybacks.
And CapEx projection.
Projected at $4.5 billion. Still focused on optimizing the network, driving efficiency.
Okay, let's zoom in a bit. Performance by segment. Yeah. Federal Express first, the core Express business. How did it do with all these cuts?
Actually, Federal Express saw improved operating results in Q4.
Really? How?
Mainly those D-Drive cost savings kicking in. Plus, they saw higher volumes in U.S. and international export and better base yields.
Oh, offsetting factors.
Yeah, some offsets. Higher costs for purchase transport, higher wages, one less operating day. And losing that USPS contract had an impact.
But overall positive.
Definitely. What's really telling is revenue was only up 1%, but adjusted operating income up 9%.
Oh, that's the leverage.
That's textbook operational leverage, yeah. Making more profit per dollar of revenue because you're more efficient.
Okay, so Express is leveraging the changes. Does that efficiency focus carry over to FedEx Freight? It's a different beast, right?
It is, and their Q4 results were actually down. Different set of pressures there. Lower fuel surcharges hit them, weight per shipment was down, healthcare costs were up, wages increased, plus that fewer operating day thing.
Any bright spots?
A couple. Base yield was higher, and they had a $33 million gain from selling a facility. And importantly, the rate of shipment decline slowed down.
How much?
Shipments were down just 1% year over year in Q4. Compare that to down 5% in Q3, down 8% in Q2. So moderating declines.
And sequentially?
Sequentially, average daily shipments were actually up 8.3% from Q3. That's the biggest Q4 over Q3 jump they've seen since FY21. So some positive momentum there.
And pricing?
Pricing discipline looks strong. Composite revenue per hundredweight was still up 1% in Q4.
Got it. And you mentioned fleet modernization earlier. They retired some planes.
Yeah, part of the broader strategy. In Q4, they took a $21 million non-cash impairment charge to permanently retire 12 aircraft, some A300s, MD-11s, 757s, and related engines.
How much has the fleet shrank overall?
Since fiscal 22, they've reduced the fleet by a net 7%, which works out to 31 fewer jet aircraft. Significant streamlining. Okay, looking forward then, fiscal year 2026. What's the outlook?
For Q1 specifically, they're forecasting flat to maybe 2% revenue growth year over year.
Flat to slightly up.
Right. And adjusted diluted EPS between $3.40 and $4. That includes about $200 million from these transformation programs.
Okay. Now, the executives kept mentioning this volatile global demand environment and ongoing headwinds.
Yeah, what exactly are they wrestling with? And maybe more importantly, how are they wrestling with it? It sounds like more than just temporary issues.
Absolutely. And that's the key question, isn't it? How does a company like FedEx, so tied into global trade, adapt? Raj Subramaniam said something interesting. We are the referendum on global supply chains every single day.
Meaning they have to react constantly.
Pretty much. They're actively trying to match capacity to demand as trade patterns shift. Like on their Asia to Americas lane, they cut capacity over 35% in May compared to April.
It's a big cut.
Huge, including cutting third-party or white-tail capacity by 50%. They ended May with about a 20% net capacity reduction versus April on that lane.
What about the China-U.S. trade issues? Tariffs? Barriers?
That's another major challenge, that direct China to U.S. lane. It's only about 2.5% of their total revenue, but
But it's profitable.
it's their most profitable intercontinental lane, according to them. And it saw a material headwind from trade barriers and tariffs. A lot of it related to changes in de minimis rules.
De minimis, that's the threshold for import taxes on small packages, right?
Exactly. Changes there impact those high-volume, small package flows from China. So that profitable lane took a hit.
How are they adjusting?
Network flexibility is key. They've added new direct flights from Singapore to the U.S., for example, to tap into growing demand from Southeast Asia. They mentioned their tricolor strategy helps them adapt the network faster, boost efficiency, improve customer experience, all crucial when things get operationally complex.
And the USPS contract ending. That's a headwind, too.
A significant one for revenue and operating income, yeah. Mostly hitting the first 4 months of FY26, so it might kind of skew typical seasonality, as they put it.
Plus general economic pressures.
Right. B2B volumes are still under pressure, impacting express and freight, but they say they're ready to capture the upside when the industrial economy picks back up.
And competition.
Always a factor. But they feel the pricing environment is getting better, and they're really focused on revenue quality and pricing discipline, not just chasing volume.
Okay, so lots of managing costs, adapting to the market shifts.
Yeah.
But what about the exciting stuff, the forward-looking moves beyond just reacting?
Yeah, there's definitely strategic evolution happening. First big one, the plan to fully spin off FedEx Freight.
Making it a separate public company.
Exactly. Expected around June 2026. Should be tax-free for FedEx stockholders in the U.S. They've already named the leadership for the new company Brad Martin as chairman, John Smith as president and CEO.
Why spin it off?
The thinking is it unlocks more value. Lets each company, the core express ground business and the freight LTL business, focus on their very different markets and needs.
Makes sense. What else strategically?
They're really sharpening their focus on high-margin areas. Healthcare is a big one.
How big?
They hit $9 billion in healthcare-related revenue in FY25. That's driving growth in U.S. priority volumes. They also got this CEIV pharma certification for ground handling. Basically, a quality stamp for handling sensitive pharmaceuticals, first global integrator to get it across hubs and ramps.
So doubling down on high-value niches, automotive too.
Yeah, they've created a specific automotive vertical. They're targeting the premium services part of the North American auto market, which they say is an $18 billion high-margins segment.
And they have relationships there.
Deep ones. GM Supplier of the Year for the 21st time. It tells you something.
Okay. Healthcare, automotive. What about smaller customers?
SMBs, small and medium businesses, are absolutely central. Their FedEx Rewards loyalty program is key. Enrollment was up 8% year over year in the U.S. They see it as a gateway for SMBs, building loyalty, offering personalized service. It's all about smart, targeted growth.
It really sounds like despite all the global turbulence, they're showing impressive resilience. And not just cutting, but really adapting, pivoting strategically.
That's the narrative, yes.
So thinking about this for you, the listener, what does FedEx's story tell you about how these huge global companies actually manage to adapt when things get unpredictable?
Yeah, how does seeing this unfold help you maybe spot those hidden levers, the things that drive profitability and strategy and logistics, which touches almost everything.
This is complex, right?
It really is. And if you connect the dots, FedEx's transformation is pretty comprehensive. It's the aggressive cost cuts, yes, but also the deep network changes with Network 2.0 and the strategic shift towards higher margin markets.
It's not just about the numbers then.
Not just numbers, it feels like they're trying to build fundamental flexibility, resilience right into the core of the business so they can handle whatever the world throws at them next, shifting trade, unexpected events. It's about being ready, not just reacting.
And that brings us back, in a way, to the founder's legacy.
It does.
Raj Subramaniam shared this really powerful, quite personal story from Fred Smith's son, Cannon.
Oh, yeah.
After Fred passed, the family was together, and Cannon noticed something engraved on the back of his father's watch. The same watch he'd worn for years, shaking countless hands, building this empire.
What did it say?
Just 3 words, etched right there. Waste, not a moment.
Wow. That says it all, doesn't it?
It really does. Embodies that relentless drive that took FedEx from just an idea to, well, FedEx. So let's wrap this up. Key takeaways. FedEx had a surprisingly strong fiscal year, really powered by these aggressive cost programs, D-Drive, and now Network 2.0.
Deep integrated program.
They're strategically focusing more on those high-margin B2B areas like healthcare and automotive.
Smart focus.
And showing real adaptability in dealing with tricky global trade shifts.
So the final thought for you to maybe chew on. In a world where supply chains are constantly churning, constantly adapting, how might that philosophy waste not a moment?
Both in how you run things day to day.
Right, operational efficiency. But also in strategic thinking, looking ahead. How might that define the next era? Not just for giants like FedEx, but maybe for your own work, your own project.
What opportunity are you not wasting a moment on?
Good question to ponder.
Thank you for joining us on this deep dive. We hope it gives you some useful insights as you keep exploring how business, tech, and global forces all connect.